So welcome everyone. Welcome to the European Road Freight Rate Benchmark webinar for Q4 2020. Today we're going to be assessing rate developments through Q4 based on our weekly road freight rate data from Upply. And we'll be looking at the outlook for 2020-21 as well, and understanding how we expect rates to develop. Particularly we'll be assessing some of the big impacts through the last few months, particularly looking at the impact of new lockdown measures and restrictions which have come back into force across much of Europe through Q4, and also looking at the impact that preparations for Brexit have made over that particular period, and looking ahead to the next few months as well. The presentation itself will last for about 25 minutes, and then we'll move to a Q&A session at the end. So please feel free to use the Q&A tool through the Zoom webinar tool throughout, and then we'll get to those questions and answer as many as we can at the end. I should also say that for all of you attending, you'll be sent a copy of the white paper that accompanies this webinar presentation, so you can read through in detail, and we'll also send you a recording of this session today, so you can take a closer look at some of the rate data we're examining. Okay, so my name is Michael Clover. I'm Head of Commercial Development at Transport Intelligence, and TI is one of the leading sources of market intelligence for the logistics industry. I'll be your host today. Also from Transport Intelligence, I'm joined by Andy Rawls, who is a quantitative analyst here, and he'll be giving his views on rate development across some of the lanes we're looking at today. Hello, Andy.
Hi, Michael.
Thanks for joining. I'm also joined from the Upply side by William Baguri. He is a road transport expert for Upply and offers his expertise on certain lanes and rate development throughout Europe. Welcome, William.
Hello, Michael. Hello, everyone.
Thank you. And finally, I'm also joined by Thomas Nariu, who is the Chief Data and Research Officer at Upply, and oversees much of the data collection and curation and design work at Upply. Thomas, would you like to introduce Upply and just tell people a little bit about what Upply do?
Yeah, thank you, Michael. Thank you. Hello, everybody. So very briefly, Upply is offering two kind of services. The first one is a benchmarking tool and a tool to analyze and compare market prices regarding transportation. So we have prices for sea freight, air freight, and also, of course, road transportation in Europe and in the US. And this is this tool here that we will be using, and that we will comment regarding road transportation prices in Europe. And the second service is a marketplace where shippers can directly buy transportation service and transportation capacities from carriers. So yes, this is that for Upply, and this is what we will. So we will use the first tool, and we will see the data coming from this first tool in the coming slides.
Thank you, Thomas. Thanks for that. And yes, it's very important for this webinar and for the white paper as well, to be able to see the data and prices actually paid week to week, for road freight services. So we'll start off, I think, by taking a look at the European level data and the overall trends we've seen over the last quarter to get a sense of the overall picture, and then we'll be drilling deeper into some of Upply's more detailed data on individual lanes as well. So we can see here the overall European road freight rate benchmark. This is the average price paid across all the 36 lanes we track for this paper and webinar. Andy, could you talk us through the trend?
Yep, so we've got a fall in rates, 1.2% year on year and 1% quarter on quarter. And this really has been due to the second, in some cases third wave of the coronavirus pandemic. We've seen obviously lockdowns and restrictions re-implemented, but there are some key differences to what we saw earlier in the year. In contrast with the first lockdowns, we saw manufacturing facilities largely remained open, but still obviously demand has been weak relative to the summer rebound that we saw. In addition, we've seen a supply a little bit more stable than it was in the first couple of quarters of the year. At the time, we'd seen some border controls and sort of hauliers being stuck in certain places around Europe, but there's supply levels have been a bit more stable this time. We've also had an EU-wide agreement on drivers' status as key workers, so a little bit more stability there, which means really that the fall in demand relative to the steady supply has had a more straightforward effect on prices here, pushing them down. We've also seen obviously Brexit, which we'll talk about in a bit more detail later, but that was kept prices a bit higher than they perhaps otherwise would have been due to the stockpiling taking place. And additionally, this is a point I mention every time, but diesel prices really are very low at the moment. They're 16% down on what they were this time last year. So that's kind of stabilized margins for carriers at the moment, but and it's also led to the downward pressure on prices that we see in Q4.
Yes, thank you, Andy. That's a good summary of the overall situation, of course, but there's lots of variation on individual lanes. If we take a look now at this map here, we can see some of the scope of coverage really available through this webinar white paper, but also this indicates some of the scope of data coverage that Apply offer through their benchmarking tool as well. We can see some of the variation across different lanes within Europe. Thomas, would you just talk a little bit about the scope of Apply's data coverage here?
Yes, with pleasure. So this is one of the map that we use at Apply and we have created with TI. At Apply, we collect data from shippers, carriers, thousands of providers across Europe, across the world, but the data that we see here are across Europe, and we have a big focus on Central Europe and Western countries, where we have, the majority of the trades and the shipments. And yes, if we go from UK to Greece with Poland and Portugal, this is the big picture of the data that we collect at Apply.
Thank you. Yes, and as I say, we're going to be going through now and taking a look at some of those key lanes that we highlight here on the presentation. So let's dive in there, and we can see some of them spread out throughout this chart. Obviously, it's interesting to see the individual euro prices paid and how much variation there is on that map. But this chart here helps us to understand a bit about the overall picture in terms of how distance affects pricing and so on. And over the past 4 or so webinars, we've highlighted different groups and how they relate to the overall sort of pricing dynamics and trend in the market, looking at those that are at the high end of this line, those down at the bottom for shorter journeys, and also outliers that don't conform to the trend here. This time we'd like to just take a moment to assess why some of the lanes conform particularly closely to this sort of curve here as well. Andy, could you talk us through that?
Yeah, so we've highlighted the 3 lanes here: Paris, Warsaw, Madrid, Paris, and Antwerp, Lille. There's actually quite not so much in the way of unifying characteristics on these lanes, apart from the obvious French influence there. But Antwerp, Lille is relevant to French imports from the rest of the world. Madrid, Paris is a key kind of automotive lane, particularly for Spanish exports. Paris, Warsaw is a backhaul lane which tends to react to price fluctuations on the front haul for consumer demand for goods coming into Paris. And we also wanted to look to see really whether there was, I would have expected that an even front haul and back haul where the rates are well matched would conform quite well, but that's not necessarily the case here. You can see, for example, Antwerp, Lille, where shippers were paying I think €2.94 per kilometre, but the back haul is a €2.49 per kilometre. So there are some differences here, but really I think that's just testament to the fact that there's a lot that goes into the pricing on these lanes, the mix of demand, the actual stability in that demand, diesel prices, driver costs, tolls, the extent to which there's cross-day or cabotage operations taking place. So for me, really, this kind of just shows the complexity of the pricing process on a lane-by-lane basis.
All right, thank you, Andy. Very interesting. And obviously, as I say, when we take a look at some of the individual lanes, you can see some of that complexity and the fluctuation and volatility coming through. So on these charts, we're looking at some of Europe's most high volume lanes and examining price development across these really. William, I wonder if you'd like to comment on the Madrid, Paris and Duisburg, Lille lanes for us to give your perspective.
Yes, of course, Michael. Rates on the Madrid to Paris lane fell 2.3% compared to Q3 or 3.1% compared to Q4 last year. And on the backhaul, rates on against the last quarter by 0.5%, but represent an increase compared to Q4 last year. So Spanish export in the automotive and construction sectors have been hit hard by the pandemic. And reports suggest that the export from automotive sector declined by 20 to 30% for the year. So it's massive. And French import demand has been particularly weak, especially during the national lockdown implemented in late October and November. So according to the OECD, this led to an 18 reduction in retail trade volume from October to November. So to sum up, demand has been much weaker than supply in both directions, and so the price have gone down. And we can notice, however, that Spanish hauliers have lost 6 to 8% of their workforce, leading to a lost production capabilities, but this helped to avoid a steep fall in prices. For Duisburg, we can say that the slowdown in economic growth weakened rate on Germany-France lane in Q4 in both directions. Following a good recovery in consumer spending over the summer, largely due to a pent-up demand, the French expenditure on consumer goods in the Q4 peak season appears to have been particularly weak, as mentioned earlier, due to the lockdown. And this contributed to a 1.5% fall in front-haul rates quarter on quarter. And on the backhaul, rates has slid quarter on quarter for the third time in a row. Amidst the pandemic, Germany's sourcing requirement for intermediate goods from other countries in Europe has fallen, and directly influencing import demand from France. However, the fall in rates has moderated over time, and in this quarter, the contraction was just 0.7%. And we noticed that German car manufacturers had increased their orders from their suppliers in Q4. And this probably explains the good resistance of prices despite the lockdowns on both sides of the border.
Yes, thank you, William. Very interesting to see how demand is shaping those rates and holding them up and sustaining them, as you say, maybe a bit more than possibly expected. Andy, could you offer your view on the Duisburg-Warsaw lane, please?
Yeah, and a similar story here in terms of the pandemic reducing demand in Q4. Again, I'd like to kind of contrast that to what we saw earlier in the year. And we don't, in Q4, there wasn't so much of the frantic border issues that we'd seen earlier in the year as coronavirus swept across Europe. There's also been a more consistent supply of Polish hauliers as well on this lane. So that's meant that supply has been stable and the demand drop-off has really been what's influenced this rate decline. But I think also you can see is that, the rates here for Duisburg to Warsaw and the backhaul as well, they've been generally higher against last year. I think I haven't got the overall annually, they have been higher than they were in the previous year, and that really reflects the performance of the German and Polish economies, which obviously has been seen in decline, but relative to its peers, they've performed a little bit better. So that's why those rates are still sort of trending up and to the right slightly.
Okay, thank you. Very interesting. So that tells us a little bit about the impact of coronavirus on the rates, and we can see that through the way demand is changing, the capacity there. One, of course, other issue which has been front and center over the last month or so, but obviously particularly towards the end of Q4, as we started to see everyone preparing for Brexit and the changing regulations on the cross-channel trade. We were expecting to see some tumultuous change and volatility on that lane, and we've measured that with the index rates here to try and show a bit of a trend as we can. Andy, can you talk us through what happened on the UK lanes?
Yeah, so essentially we saw a bit of a divergence, actually starting in Q3, but also into Q4 here from the non-UK rates. You can see obviously they follow a pretty similar pattern up until sort of Q3 and Q4. And rates here were 1.1% up year on year, which contrasts against the non-UK rates, which were down 1.8%. So really, this is a result of stockpiling either side of the channel. We saw that throughout the last few months, really. According to the UK Warehouse Association, in November, available UK warehouse capacity was running at under 3%. So it was really, really strong evidence there that shippers were rushing to get goods into warehouses ahead of the Brexit deadline, whether or not there would be a trade deal implemented at the time. And we also saw that in terms of crossings over between Dover and Calais. Apparently there were sort of reports suggesting 9,000 trucks per day were attempting to cross between Dover and Calais, which is 50% higher than usual levels. So there's a big difference there. One thing that we were asked about, which we didn't see too much of, was when the French implemented blocks on UK on hauliers going back into France towards the end of the year as a result of the new UK variant of COVID. That hasn't had so much of an effect on rates, just because it happened so late towards the end of the year, really. But the overriding factor really on this, as you can see, it's been Brexit, and that has produced increased rates for the UK rates as a whole.
Yeah, it's very interesting to see the impact there, and of course we're looking ahead now to how that's affecting rates as Brexit is actually implemented in January. William, could you offer a European perspective on the impact of Brexit?
Yes, thanks, Michael. So I'm responsible for giving the continental view of Brexit. And I'm sorry to report that the consequences of Brexit are still not very clear or fully known. As of March 1st, there will be a new unit at the European Commission in charge of monitoring the application of the EU-UK agreement. And Michel Barnier becomes special advisor to the president of the European Commission on the implementation of the EU-UK agreement. So the IRU, so the World Road Transport Organization, will prepare a document bringing together all these questions to then address them to the European Commission. And this question will relate to on access to the market and posting and cabotage, on the transport of live animals, more generally on sanitary and phytosanitary controls, on the recognition of the European health insurance card, on goods and accompanied transport, on customs declaration to be made in advance, otherwise risk of hard blockage at borders, on IT problem at Irish borders. So it's clear, in fact, that it's really not clear. And this uncertainty generates additional cost, which can only generate a decrease in capacity and increase in transport prices, regardless of transport demand.
Thank you, William. Very interesting, really, to see that effect, and we'll be tracking that as we move into Q1 as well, to review the impact. Hopefully, it will become clearer as time goes on. We're all, tracking these developments to see how everything will pan out. Now, if we also want to think ahead, really, not just for thinking about what Brexit will do and how it will impact rates, particularly the cross-channel rates, but also thinking ahead to the rest of 2021. Obviously, as we're now at the end of a full year of rate development, it's a good chance to take a bit of a stock take on what's happened over the longer term in terms of freight rate developments and the trends which have shaped that, and of course looking ahead to how we expect rates to develop across 2021. So a logical place to start there is by looking at the trends as we've seen them, and perhaps as we've overlaid here, the annual versus the quarterly development. Andy, could you talk us through this?
Yeah, so obviously we've got the first four full years of data here, and we can see a 1.6% decline in rates in 2020, and that's the first decline we have. 2018, the growth rate was 4.4%, and 2019 was 1.5%. And the benchmark rate this year, by the way, is 1.55 per kilometre for the annual rate. So this year really has been about the significant decrease in demand, particularly around April, and this kind of slow recovery since then. But also obviously the supply levels, which have been stable at times too. Earlier in the year, obviously I mentioned before, there have been border issues too. But I mean, prices have only fallen, as I said, 1.6%. But I could remember carriers have thin margins, and those prices can't go too low, particularly given how they're getting less shipments anyway. So that's right. The reason really the prices have stabilised at just 1.6% below prior year levels.
Okay, thank you, Andy. So when we're looking ahead to think about the rate development in 2021, it would be interesting to think a little bit about expectations. But so these are 6 of the sort of factors that we think are really going to be influencing freight rate development over the course of this year. And I'll ask Andy and William to take us through some of these each. But Andy, perhaps you'd like to give an overview really of how you expect rates to develop given some of these factors, and talk us through how each of these would affect rate development.
Yeah, well, I mean, I think what we've seen from most of these factors is that prices look likely to increase over the short term, over the next year or so. I mean, we look at the COVID recovery. I guess the point here is obviously vaccinations have begun across Europe, which, I mean, the rollout's obviously been bumpy, but hopefully that'll bring back the pandemic under control in Europe, and we'll start to see further economic activity spurred from that, particularly hoping that the retail sector will start to recover, which obviously that's really suffered as a result of government-imposed lockdowns and restrictions. So we really hope that that's going to recover and lead to a higher demand, which was upward pressure on prices. In terms of diesel prices, I mean, these have obviously been rock bottom lows for quite some time now. That started really at the beginning of last year with the pandemic starting, and also with the geopolitical issues between Saudi Arabia and Russia. But I mean, it looks like the only way is up in this area. So that's really again likely to push prices up in that area. And finally, Brexit, which I've just spoken about, really. And I think, just adding to what William said about the complexity that we've seen, and that leading to potential price increases. Obviously, we've seen the additional bureaucracy that's going to be a burden to carriers. Some carriers have already had to halt services. Some of that will be short term, some of it will be teething problems, but I don't think you can doubt that there will be additional bureaucracy as a result of this. And we'll be seeing border checks being implemented throughout the first half of the year as well. So this impact really is likely to lead to high prices as well.
Yeah, absolutely. Well, certainly very interesting. I know we've seen, I think the probably most high profile one was, I think, Schenker, which had stopped doing or interrupted some of the cross-channel operations. And we've also seen, in discussions with the retailers, particularly for online retailers selling into Europe, a lot of them stopping that now after having to send other charges through for customs declarations and that sort of thing, sometimes costing 20, 40 euros, which made obviously the business totally uneconomical. So very interesting to see how that develops and how it affects the overall flows over the longer term. William, could you take us through some of the other trends here, starting maybe with sectoral changes?
Yeah. Most financial experts expect a rapid recovery, but in the third quarter. So this acceleration of the economic recovery in mid-2021 is expected to fuel demand for freight transport in Europe. So a return of cyclical sector is expected. I'm thinking of the automotive sector and the building sector. Both will be driven by the energy transition. So I mean electric or hydrogen for the first, energy standard for the second. Everyone should benefit from the national and European massive recovery plans. So it's also likely that e-commerce will continue to accelerate. So cross-border look set to continue growing rapidly. Under this condition, we could talk again about driver shortages. In 2010-20, many drivers left the profession, especially in coaches or bus transportation. And in 2021, so will be also the first full year of mobility package enforcement. Or according to Massif Ronsky, sorry for my pronunciation, president of the Association of Polish Employers in Transportation and Logistics, carriers in Central and Eastern Europe could experience a drop in revenue of 1.3 to 2 billion euros, a drop productivity of about 20%, and a permanent loss of 40 to 60,000 jobs in international transportation. So this explains why several Eastern European countries have decided to fight mobility package adopted in July in 2020. But for the next several months, the most pressing issue for hauliers will be liquidity. The risk of default and insolvency is high. Many small road transport companies are at risk of going bankrupt in the coming months, and warned the IRU. And they claim more than 125 billion euros in cumulative losses since the start of pandemic in Europe for all the transport sector. So it's massive again.
Mm. Thank you, William. Well, it's certainly very interesting to hear about what will be shaping rates as we go forward into the next year there. And obviously we're thinking about some fairly major changes coming in over the next few months, of course, and we're thinking about large changes we've seen. We have a chart here which basically highlights the biggest price change we've seen in the last quarter, in this case for Milan to Warsaw. And obviously, look, there's a very strong drop-off there over the last 4 or 5 quarters. William, could you explain what's led to that?
Yeah, I certainly don't want to sound offensive or condescending, but the curve looks like the mountains that cross between Milan and Warsaw. For 4 quarters in a row, prices have been falling, and today the average is equivalent to that of 4 years ago. In my opinion, this is due to 2 main facts and 1 particular environment. The first fact, Polish industry has greatly asserted itself and is becoming more productive. So this will therefore has an impact on the drop in demand between Milan and Warsaw. Then the second fact, the fall in auto sales increased the supply of transport, which carried out to all other flows. And finally, the particular environment, geographically, the Milan-Warsaw flows is at the crossroads of routes taken by low-cost European fleets. So I'm thinking of the Poles, of the Hungarian, the Romanian, the Bulgarians, without forgetting the Slovaks and the Czech. All this forms a bearish cocktail.
Well, thank you, William. That's very clear. And so we'll be interested to see how rates continue to develop on this particular lane. And of course, we're always watching out for key developments across different lanes. And Milan to Warsaw has previously been a lane to watch for us. This time, though, we're looking at Rotterdam to Duisburg as our lane to watch for Q4 and maybe this coming few months as well. Andy, could you explain why we're so interested in this lane?
Yeah, so I mean, in Q4 we've seen this lane buck the trend in terms of an actual increase in rates into Q4 by 3.1% against Q3. I think that really shows that in German manufacturing, some of the trading relationships are changing. Contrast this with Lille-Duisburg, where intermediate imports are down. So it looks like Germany's sourcing more from outside Europe. China appearing to be the leading market there. So I think we can see when we're looking ahead here, if Europe continues to underperform, if certain sectors around Europe don't pick up quickly, then Germany will keep looking elsewhere, and we expect to see rate increases on this lane as demand continues to rise. Conversely, if there's a quicker European recovery, we might see perhaps more of a switch back to maybe those inputs from Lille instead from elsewhere. So this one could go either way, really, and it would depend on the shape of the pandemic in future.
Right, very, very interesting, and obviously as we go through these slides, and we're focusing on these individual lanes and the prices paid here, and you may have questions about how the data is put together in a bit more detail, how Apply actually gather and collect this data. So I think it's worth, Thomas, if you wouldn't mind taking us through some of the methodology that's applied to produce these figures.
Yeah, I will be very quick to go with the questions because we have some few times left. But I mean, very briefly, the data that we collect are transactional data, so data that we collect from invoices. This is quite important because these are real rates that we take from the market, from shippers, carriers, freight forwarders. What you saw are aggregated rates in terms of a full truck, but we have also data for LTL. And also for different kind of goods, liquids, for flatbeds in terms of trucks. So please feel free to contact me, to reach me if you have any questions. It will be easier, and we will take 30 minutes to go through this data. Yeah.
Okay, thank you, Thomas, for explaining. So that concludes our presentation today. But of course, we're very happy to answer some of your questions now, having been through our overall presentation. So we've already got some questions that have come in. So I think we'll start with the first one, which is, what is your understanding of the cabotage rule for European carriers coming back empty from the UK? Well, Andy, perhaps you'd like to offer your view on that one.
Yeah, so I mean, I understand that obviously cabotage is going to continue under the Brexit agreement, and the EU hauliers will be limited to a maximum of 2 journeys within the other's territory before having to return to their own territory. So that seems okay there.
Okay. All right. Well, if we're looking at some of the other questions here, we have a second one from an anonymous attendee on this occasion, which is asking about, do you expect an increase in rates based on the global fuel increasing rates? I think Andy already addressed that a little bit with saying that our expectations were for rates to fuel prices to increase and rates to increase. I don't know if Andy wants to add anything to that, or maybe if William, you have a view.
Yeah, I mean, I think really it ties in with the other factors as well, with demand returning, with Brexit, for example, as well. So I think essentially it's this kind of cocktail of these issues as well, which are likely to include to lead to a rate increase. So, but that diesel cost increase certainly will make a difference.
And William, did you have a view on that? William, did you have a view on that one? Perhaps not. Perhaps we can.
I was on mute. Sorry.
Oh, sorry.
So just to say that in my crystal ball, I can see that we will have enough capacity for the Q1 and Q2, but we will have a change, a massive change in Q3. So maybe yes, we will have a lack of capacity and shortages in Q3, and so the prices will raise.
Okay, thank you. All right, so we have another question here as well, which is looking at rate expectations for Q1. I think William's just given his view on that, but Andy, do you have a view on expectations for Q1?
I suppose, I mean, I'd expect potentially flattish now. I mean, I was saying earlier about the likely rate rise, at that more likely to be towards the second half of the year, towards the end of the year. But I think, given that obviously the demand picture at the moment is similar to Q4, maybe a little bit of a recovery, but still lots of lockdowns and restrictions everywhere as well. So I'd say flattish, and then the crux of the rate rises potentially more likely later in the year.
Thank you, Andy. Okay, and we have a few more questions coming in, actually. A couple here which look maybe like questions that might be good for Thomas to answer. So we have one here which is on what is the evolution of ambient versus temperature controlled data. So of course, as we say, we're looking here at the overall rates for the European road freight market. Thomas, does Upply have more granular data looking at some of the
Yes.
temperature controls?
Yes, we have, and I will give a broad answer because I will need to look at within the data to answer precisely. But in 2020, we see an increase of temp control regarding ambient. Why? Because the demand for ambient was decreased with coronavirus, whereas the temp control was quite stable because of all the foods, and that was keep going. So this is the thing that we saw in 2020, an increase of temp control versus ambient.
Okay, thank you. And again, there's another question here which is asking about, do you have a zoom in on Brexit and COVID impact on rates at the end of December? Well, Upply, of course, have the more granular data. So you would have that available, Thomas, wouldn't you? For more high frequency data, looking at the end of December, for instance, and start of January.
Yeah. We have some data regarding exactly that. Regarding UK versus Europe, but the data. With the Brexit, we had fewer data regarding the number of shipments, and we had some troubles. The trouble that we had on the news with the UK and some trucks that were stuck. So it's kind of blurry period, and we need to go and to look deeper in the data, but you can find the data on Upply.
Okay. And then a couple of questions maybe for William, perhaps to finish up with. We're looking here at, obviously, William, you mentioned earlier about solvency for trucking companies. So we've got a question here asking about what the consequences of that will be. So do you think there will be consolidation, and or do you think there'll be major price increases if we see more businesses going out of business?
Yeah, in fact, we can say that maybe there will be a consolidation of the transport sector in 2021. Yeah, this is a major expectation that we can expect. Yeah. And for the other question about mobility package, honestly, it's a question of it's a question of negotiation. But if I wear the shoes of Marcin Wronski, the president of the Union of Transportation and Logistics, the Polish association, he said he had to the commentary that maybe in the second scenario, we can expect that with the recovery, they will increase drastically prices. So yes, it will affect massively prices, but by the end of 2021 for the mobility package.
Okay. Thank you. And we've got just a couple more questions here. I think I saw a question which is asking. Here we go. Yes. So we've got another question here. Have you observed any trend for the variance of lane FTL prices by quarter? Well, of course, as we go through each of these charts, and in the white paper we do cover exactly that, the rates and prices per quarter. So I think the white paper would be a good place to go if you wanted to access that trend, really, which we'll present out to everyone attending after the presentation is concluded. Okay, I think that's all the questions. So thank you very much for everyone who asked the question and engaged with the webinar, and thank you very much everyone for joining us. It's a pleasure always to go through one of these benchmark webinars with you all. And all that remains for me to say really is thank you very much for our panelists, for Thomas, William and Andy for joining us and giving their views on road freight rate development over Q4. And we very much look forward to seeing you all next time for the Q1 benchmark in a few months' time. Thank you. Goodbye, everyone.